My name is Steven and I lead the private wealth team for Swan Bitcoin. That is our concierge service, our white glove service for high net worth investors, for family offices, businesses and corporations. And we also serve trusts and retirement accounts. We're a one-stop shop. We've got Lynn Alden, we've got Natalie Brunel, and we've got Hafa, Swan Bitcoin's Chief Investment Officer. You're gonna love it. It's gonna be an amazing panel. And we're thrilled to put it on.
Thank you so much for joining us for this session on macro trends and Bitcoin portfolio strategy. Really honored to be up here with Lynn Alden and Hafa Zagori. Hafa, again, is the Chief Investment Officer at Swan. And Lynn is a household name, so I want a chance for both of you to introduce yourselves. So Lynn, for those who somehow don't know you and follow your amazing newsletter, give us a couple of words. And then Hafa, I want you to share your background too, because for people that aren't familiar with him, he created the Nakamoto portfolio, this open source tool for managing portfolio allocation, and really interesting background, 15 years in the finance world. So let's hear an introduction from both of you first.
So my name's Lynn. If you don't know me, my background is engineering, but I over time shifted more towards investment research. And in the past couple years, I've also got involved in the Bitcoin startup space. So I serve on Swan's board of directors, and I also work with Ego Death Capital, which is a Bitcoin-only VC fund to help seed stage companies.
Thanks, Natalie. Yeah, so as Natalie said, I worked for 15 years in Wall Street, worked at companies like Goldman, Merrill, all kinds of things, and a lot of it in trading. And through that time also looking and working a lot with ultra high net worth individuals, family offices, endowments, pension funds, doing all sorts of trading, different asset classes. Then I also started my own company a few years back, when I was back to Brazil. But had been a Bitcoiner for a while, and one of the big challenges I've always had is, telling my fiat friends, how to put Bitcoin and how to look at Bitcoin in their portfolios, and that's how the Nakamoto portfolio was born. Was from conversations that I had with former clients, investors that didn't really know how to fit Bitcoin in their portfolios. I tell a story about one of my very good friends who invested in hedge funds for a long time, and he would invest in all different managers. He actually invested in Madoff, and then I kept telling him I should have Bitcoin in your portfolio. It makes sense. And he kept asking all these different questions. And then what I did is I printed Bitcoin returns in a sheet of paper that looked like a hedge fund manager returns, and sent it to him. And I said, "Oh, there's this hedge fund manager I'm invested. You should invest in." And that got him curious, because then he looked at it, and then he told us, I'm definitely overthinking this. This is the way to look at this. I shouldn't be thinking too much about the question, because if it was a manager, I wouldn't be asking all these questions. So that's how the Nakamoto portfolio was born, from these conversations.
Well, we're going to hear a little bit more about that and what even a small allocation to Bitcoin does for a portfolio. But first, let's talk about macro a little bit. Right now, I think top of mind for a lot of people is the debt ceiling. And there are some headlines out there saying that negotiations are moving forward. Other people think there's going to be a government shutdown. So Lynn, I'll start with you. How do you see this playing out and ultimately resolving? Because we all know the debt ceiling is going to be raised eventually.
So obviously with the debt ceiling, the consensus view is probably that they're going to come to a deal at the last second. Whenever everybody believes one thing, I worry that another thing is going to happen. So maybe they go over the limit for a week and it causes all sorts of problems. I generally don't try to predict too much what they're going to do, because it kind of comes down to a handful of politicians and people kind of running this. Instead, my focus is on what happens after, because for the past 6 to 8 months, we've actually been in this sideways liquidity environment, and partly because of the debt ceiling. So the Federal Reserve's been draining liquidity out of the system with quantitative tightening, but at the same time, the Treasury has actually been pushing liquidity into the system, in large part because they had to draw down their cash balance because they couldn't issue more debt. If you ran out of your income and you couldn't access debt markets, you still wanted to pay your rent or your mortgage, you'd have to start drawing down your cash balance. And that's basically what the Treasury's been having to do. And they've drawn down from over $1 trillion in their account, now down to something like 100 billion. The numbers released daily, but it's very low. And the question is, once they actually raise the debt ceiling, you no longer have that treasury offset. And so I think there's going to be some interesting decisions by Fed or Treasury officials in the second half of this year on how to manage liquidity in an environment that still has some inflationary pressures. And there's a chance for either the Fed or the Treasury capitulates in some way and provides more liquidity into the market, which they don't really want to do, or they run into a really big liquidity problem and you get a pretty sharp sell-off in financial assets. So that's kind of this like decision point that I'm watching pretty closely is after the debt, not just the days and weeks after, but the months after that liquidity injection is no longer there.
Well, then there's a lot of uncertainty in the markets because of all that, and I think also contributing to that is the banking crisis. And I wanted to get your take because we've seen some banks fail. We've actually had greater financial loss already than we saw in 2008, but yet our bubble's so much bigger, right? The Fed keeps hiking interest rates into this environment. A lot of people are expecting more bank failures. Can you speak to the banking crisis and how that also has impacted Bitcoin's value proposition?
So basically, I bring up the 1940s a lot, which is the other time when there's very high debt in the system and the Federal Reserve is trying to get off the zero bound, which is pretty hard to do. And back then, they did it very gradually. They did yield curve control. They kind of let currency be the release valve as they tried to, eventually get off of that position. And here, they tried a much more rapid approach, which is jack up interest rates super high while there's still all this debt in the system. And when you go from 0 rates to 5% rates in a little over a year, in addition to being the highest, this like the second highest, year-over-year basis points change in interest rates, but it's the highest ever, percent change in interest rates because you're coming off such a low baseline, and the financial system's not really able to contain that. And so it's kind of surprised me how aggressive the Fed has been, and they've caused problems because of that. So they've kind of elected to solidify their currency a little bit more, but then the cost of doing that showed up in financial instability. And one number I like to look at is the failures of banks as a percentage of total bank assets. So to your point, it's the biggest, actually more bank assets technically failed in 2008, but it's a smaller percentage of total bank assets because we've had 15 more years of bank asset growth. So it's still smaller on a relative basis, but it's a very meaningful total bank problem. And it's not clear that it's done yet because we still have these kind of mismatch between short-term rates and long-term rates. And I think one of the things it does, it starts showing us where the ceiling might be for how quickly the Fed can raise rates without causing severe instability. And then that gives certain assets like Bitcoin a chance to be more bid because it's kind of reducing forward expectations of market hawkishness for a period of time. And so the combination of liquidity turning up, some of all that leverage stuff that happened late last year kind of behind us now in the space is giving Bitcoin, I think, a good base to start building on. And then of course it presents a pretty strong narrative game. I mean, this is, I'm sure plenty of people at the conference talked about it. It's well covered in the media. So much is like when we interact with banks, a lot of what's under the surface is kind of obfuscated from us. We don't see all the risks that happen there. It's really easy to bail it out and stuff. And what this kind of did is laid bare some of the risks you take when you deal with banks. And of course, in the United States, we're pretty privileged. We're getting a small taste of what it's like when you bank in most other places in the world, especially if you want to bank with dollars. For example, I have family in Egypt. And when they hold dollars, they hold the actual dollars. They wouldn't put them in the bank because Egypt can have a dollar shortage and say, hey, we need the dollars, so we went ahead and converted your dollars to Egyptian pounds at the exchange rate we chose. That's happened in Argentina before, that happens in banks all around the world. And it just shows that banks are really risky. And even in relatively stable jurisdictions, they can run into all sorts of problems, especially when you have a very high debt system and the Fed is trying to save the currency by tightening as fast as they have.
So many people around the world understand counterparty risk in ways that a lot of Americans don't. And to your earlier point, it feels like we have no ceiling when it comes to debt, but we will have a ceiling when it comes to rates. And just speaking more to the issue of banks, Papa, with your experience working for some of the biggest banks, any takes?
Yeah, I think Actually, I'll talk a little bit about countries because I was born and raised in Brazil in the years of hyperinflation. And, a couple of things we saw. The first one, everything was dollarized. And as Lynn said, everybody wanted to hold dollars, right, as a reserve currency. So you would have the local prices, wouldn't mean anything. The real reference that you had was actually on the dollars that were the strong, at that point, the strong currency, right? And if you don't think that can happen in other places of the world, you're mistaken. It just happened in Argentina, right? We have several places, and it's all the same thing. We have money that should be our reference that keeps losing its value, right? Yeah, and in terms of the banks, one of the reasons I left Wall Street is because Wall Street changed a lot. Like when I started working there, it was very entrepreneurial, people, building different things, and it just became more and more a lot of regulation on everything that you did, to the point that, whenever I wanted to do something that was a little bit more complicated, we couldn't get done. And that's happening across the board, right? So that's why we also saw fintechs, coming out of the wood, taking pieces of hedge funds to start with, right? Because all of this risk that was supposed to be in banks can't be anymore. And the regulators are the ones that are setting the tone. So banks are utilities these days. They're not banks like we used to see in the past. And it's important because if you're managing risk, you should be able to manage risk across the board, right? Across every asset class, the way that you want, and banks definitely can do that anymore.
I definitely think we're going to see more bank failures. And let's talk a little bit about the idea of a soft landing. Lynn, in your research, you talk a lot about the economic data that we see decelerating. Inflation has come down. We're seeing manufacturing numbers decrease, consumer sentiment decrease, consumer debt increase. Can you give us a take as all of this sort of intensifies and accelerates? Are we going to have a pretty severe recession?
I think because the system's so centralized, that really comes down to a handful of decisions by policymakers. And right now, of course, they're in this decision point where they're favoring economic contraction, risking a hard landing to try to get inflation under control. So if they were to decide politically that it's less bad to have inflation run hot for a period of time, they might be able to engineer a soft landing, but the cost would be higher inflation. So that's kind of the trade-off, and we have to see what they want to do. And in a very centralized system like that, it really kind of comes down to a handful of people, the Fed, Treasury, and things like that. To the extent that we have a soft landing, in some ways it's for bad reasons, because we have very, very large fiscal deficits. And as asset prices stop going up, if they just go sideways, let alone if they go down, that dramatically impacts tax revenues. And we've already started to see that show up over the past 4 months, 6 months. And so it actually blows out the deficit even further. So even before any sort of official recession, we're currently running at something like a $2 trillion annualized deficit, which is like a mid to high single-digit percentage of GDP, which is very high by non-recession, non-COVID crisis standards. We only really exceeded that in a couple years. And those are just constant. Every year it's just going to be large, like these very, very large nominal debts, very large deficits as a percentage of GDP. And in some ways that does soften an economic impact, but it comes at the cost of, that is a source of money creation going into the economy. It's currently being offset by quantitative tightening and things like that, but of course they can't stand that forever, especially once you get past the debt ceiling and you actually want to start financing this by debt again rather than cash drawdowns. And so to the extent that we have a soft landing, I think it would be a somewhat stagflationary one. It would be because they didn't achieve the full objective of getting inflation down. And so I think these two trade-offs, I don't really see a period where we just have smooth disinflationary growth, say this year. I think it's kind of that choice between hard landing and probably temporarily getting inflation pretty low, or inflation kind of keeps surprising to the upside, stays sticky, doesn't come down as fast as people think, but then the economy also kind of stays stronger for longer. And I think that's kind of that's what we've been in for the past quarter or two, where the economy stayed stronger than many people expected, but also inflation has stayed hotter than many people expected.
You've been actually saying that we're going to chop sideways and we're going to see more stagflation. It's interesting because you kind of answered, I've been wondering why there are some analysts who say we're about to have a negative inflation print. We are decelerating quickly. It could be a debt, bust. And then others saying we're going to have 2-digit CPI, double digit. I mean, I can't even imagine what would get us there, since before we had a pandemic that had a government shutdown, in fact, affecting supply chains, as well as, you know, fiscal stimulus. So I guess, you know, can you help paint a better picture of how this is going to influence not just Bitcoin's performance when they do eventually pivot, let's say, and initiate the money printer again? Aren't they going to have to print more than they've ever printed before? Is it going to impact assets? Is it going to impact CPI? And how will it impact Bitcoin?
So to your point about negative inflation versus double-digit inflation, there's a really good quote by Stanley Druckenmiller the other day. He's one of the best traders. And he's like, I can make the case for deflation or 8% inflation because it's such a wild setup. And again, it's partially, the reason you can make such a credible case for either direction is because there's a very small number of policymakers that effectively get to decide the odds of which one we hit. If they want to have a hard landing and get inflation down to temporarily negative, they probably can. On the other hand, if they want to try to preserve the economy in some directions, it's going to be very hard to keep inflation from not having another wave. Trying to predict the magnitude is challenging. I don't think my base case would be not to see the type of liquidity event that we saw during the lockdowns and everything like that. That was a uniquely severe event in terms of rate of change and the response they did. I think the kind of liquidity events we're more likely to see, and again, this can vary based on events that are unpredictable, but I think the base case, until I see otherwise, is to expect just a longer grind of liquidity. So maybe not that much liquidity in 1 year, but just year after year after year after year, these deficits are still pouring money into the economy, and we still have these ongoing liquidity issues, and the Federal Reserve is probably going to have to finance at least part of that. And the question is, what if they have to finance it when inflation's above their 2% target? And they might have these kind of like weird decision points where they end up looking like an emerging market, or maybe like emerging market light. You know, depending on how bad it gets, it might, you know, hopefully will not be quite that bad. But I think that's kind of the base case I see. And I think the type of credit or type of liquidity they do is likely to be more targeted because they'll be more cautious and aware about inflation. So instead of just handing out money to everyone and PPP loans that turn into grants, I think it's more like selective liquidity provisioning. Like trying to keep the treasury market liquid enough while still trying to keep bank lending tightish. And so you kind of have like two different markets for credit.
Well, the other question this poses is, how do you invest in this environment? So let's shift over a little bit and talk about the portfolio, the Nakamoto portfolio. First of all, for those who have not heard of it, Hafa, what is it? How did you come up with it?
Yeah, so when I started doing research at Swan, you know, one of the things I wanted to do was something very different than, again, what I've seen in Wall Street, right? So what we've done at Swan Research is that we open source everything. So all the code of the calculations that we do, you know, auto models, it's all open source. So we'll explain what it is, the code to replicate it's there, so anybody that wants to check in, very much in the details of Bitcoin, right? I've been a developer in some open source projects in the past, and again, just made sense to do the same thing for research. The first pillar of Swan Research that we launched is what we call the Nakamoto portfolio. And on the Nakamoto portfolio, we started with asset allocation, because that's one of the things that our clients ask all the time. It's like, how Bitcoin fits in our portfolio. Should I allocate 1%? Should I have 5%? Should I have 10%? How should I buy? Should I buy slowly? Should I buy everything at once, right? So it made a lot of sense to develop tools that would help our clients to make those decisions at the end of the day, right? Asset allocation being my background, it's where I started. I had developed a lot of these tools through a long period of time. So what I did is compiled everything, and initially we had this discussion at Swan of, okay, so we're going to create a platform that our clients can come in and can take a look at everything, and we're going to create dashboards, right? We prefer to do it, again, open, free, anybody can go to nakamotoportfolio.com, and it's very simple. So there's several tools there. The portfolio allocation tool is one where you go and set up, say, okay, I want to have a portfolio that it's a 60-40 portfolio as an example. So I'm going to put 60% of stocks, right? Use S&P, whatever you want, and then I'm going to put 40% of bonds. there are preloaded portfolios that we included there. So we have commodity portfolios, we have traditional portfolios, as I said, it's a 60-40. I have David Swenson's the Yale portfolio there as well. So there's several portfolios that you can run, and you can see what would happen if Bitcoin was included. What we see in most cases is that, of course, everybody has in their mind, oh, you're going to increase my drawdown, my volatility, right? And it does, but increases your returns significantly, and increases, when we talk about risk-adjusted returns or Sharpe ratio, right? I still to find a portfolio that, of course, it really depends on the period of time that you're looking at, but the Sharpe ratio typically increases on these portfolios. We actually have a funny portfolio included there, which I call the rat poison portfolio, which has Berkshire Hathaway, JP Morgan, BlackRock, and something else that I forgot. But anyway, it's Bitcoin's biggest critics, and you run that against a Bitcoin allocation, and surprise, surprise, the Bitcoin allocation could improve their returns significantly as well. Right?
Well, and you visualize it. You see that the 60-40 portfolio is dead. You need Bitcoin, and even though a lot of people who don't understand the asset see it as very volatile, even like you mentioned, even with that volatility, you can see with the tool that whether you're a young investor, whether you're more diversified, whether you're near retirement, want to be less, you want to be more conservative, Bitcoin really pays off. Can you give some examples? And maybe I'll actually challenge you. For someone out there, let's give you 3 scenarios. For someone out there that's 25 years old, has a lot of earning potential, versus someone 45, maybe has a family to take care of, wants to start to plan for college education and retirement, versus someone who's 65, getting ready to retire. How do you diversify, or how do you allocate to Bitcoin and make those decisions?
Yeah, and again, we have these conversations all the time, right? So I'll start with the older, more conservative side. So we have clients that are sitting right now on a pile of cash, investing treasuries, right? Which again, in some sense makes sense because treasuries are yielding, good yield right now. So it's actually pretty incredible when you put Bitcoin in these portfolios, right? And it's all about sizing. So a 1 to 5% Bitcoin allocation to these portfolios, it actually can reduce the drawdown risk that they have in some points, right? We just went through a period where interest rates kept going up significantly. So some of these investors, like, I have friends in Brazil that what they do, they say, oh, I'm diversified, I have very diversified fixed income portfolio. And first of all, you see that they have very large, long duration portfolios, right? And also highly concentrated in Brazilian issuers, right? What happened when interest rates went up significantly and Brazil risk exploded? Well, their portfolios got crushed. So what they thought was a very conservative portfolio, in fact, was down 20, 30% in some cases. And in these cases, when we run Bitcoin against these portfolios, it actually reduces their drawdown. What you can see in the Nakamoto portfolio website, we actually have a drawdown chart that you can compare your original portfolio and your portfolio adding 5, 10, 15. So it's very visual. You can see, okay, in this period of time, like 2016, for example, Bitcoin actually helped a lot of these portfolios. So it makes a lot of sense. The other thing, I think, still on the cash-heavy investors, we have some corporations as well that we have conversations with right now. And these also they need to be sitting in a lot of cash, but they have portfolios that are yielding 5% right now because of treasuries. The conversations we're having is like, listen, this is the perfect time to allocate to Bitcoin. Use some of that yield that you're receiving, on a monthly, quarterly basis to allocate to Bitcoin. So in a sense, kind of like dollar cost averaging. And then after 1 year, you're going to have a 4, depends on where interest rates are going to go, right? But assuming interest rates don't get cut dramatically, you're going to have a 3 to 5% allocation to Bitcoin, and you never touch your principal. Your principal is still invested in treasuries. So in a sense, this is a good time to be dollar cost averaging. On the other spectrum, you of course have younger investors that will come to us, with their portfolios, typically highly allocated to equities, right? And people don't question, but you have a company like Johnson & Johnson and you have ConocoPhillips, which are completely different sectors, but they're highly correlated, right? The correlation of everything within the S&P 500, the correlation is extremely high. So it makes a lot of sense to add uncorrelated assets. Historically, they've been adding, private equity, hedge funds, and there are good alternatives there, but Bitcoin is the ultimate uncorrelated asset. And then another conversation we have is that we look at the whole portfolio and say, okay, so tell me about your portfolio. And I go say, oh, I'm very diversified. I have equities, I have fixed income, I have private equity, I have real estate. And then I asked, yeah, but you're all based in dollars, right? So what's your diversification there? And they just look at you like, what are you talking about? It's like that. Let's diversify your base currency as well. Maybe a low probability event, but if you know that you have a risk of the dollar collapsing at some point, this is the asset that's going to perform well at the end of the day. So not only it fits, I think, on your overall asset allocation, but also as insurance on extreme scenarios.
Well, you mentioned dollar cost averaging. I want to come back to that with a question, but first, Lynn, in our first interview, which was about 2 years ago, I remember you saying, just get off zero. A non-zero allocation is the right one. So how do you look at diversification in terms of a portfolio? Because one of the reasons I think you're so trusted in this space is you're really thoughtful looking at every asset class, commodities, gold, how you look at digital assets as a whole. So how should people allocate?
I think that depends on age and circumstance and how much time they put into understanding how Bitcoin works. The last thing you want is someone to over-allocate during a bull market, and then during a bear market, they don't understand what they bought. They sell for less than what they bought it at, so they get shaken out of their position. And so that's kind of the worst case scenario. So it says, okay, how much do you understand it, and how much volatility are you realistically willing to take, along with tail risks? You could be wrong about the asset in general. And so for me, for example, in my own personal allocation, mine is quite high, but it's not necessarily I recommend others to do that type of allocation unless they've done so much research that on their own view they decide to be that heavily allocated. So I often recommend things like 3, 5, 10% positions based on someone's volatility tolerance, and saying that's still way better than owning zero. And a general point is that the classic 60-40 portfolio, it's always kind of getting criticized these days, and maybe it's almost even overdone, people saying how bad a portfolio is. But the main problem it has is that it's entirely based on kind of a premise of disinflation. So the 60-40 portfolio became very popular over the past 40 years because of back tests and actual performance of what happened over those 40 years. Interest rates were constantly going down, so bonds were constantly giving you good returns, and then that declining interest rate allowed equities, because they're being compared to a lower and lower discount rate, allowed their valuations to keep expanding up to a point. And then also they were quite inversely correlated during recessions especially. And so you'd have this environment where both sides of the 60-40 portfolio were doing well structurally and also complementing each other. The problem is that if we enter a period of, let alone upwards interest rate, let's just say sideways interest rate, let's say we just go between 0 and 6% for the next 20 years. That's a less attractive environment for a 60-40 portfolio, which is entirely based on the premise of lowering rates, disinflation. So I'd be kind of emphasizing instead something like a 3-pillar portfolio. There's other ways you can frame it, but it's kind of like, one pillar would be kind of shorter duration types of bonds or cash equivalents. That's obviously the lower volatility side of the portfolio. One pillar is equities, which is really no different than the 60-40 portfolio, basically long-term compounding things. And then the final pillar would be various commodities or hard money exposures, things that can do well in either inflation scenarios or currency debasement scenarios, which are not necessarily the same thing, but there's obviously a lot of correlation there. And so the hard monies can include gold and Bitcoin, and of course the commodity exposures can include oil, copper, producers thereof. And I think that's a more diversified portfolio than the classic 60-40. And I think that's a good way of thinking about it. Of course, if someone is in private equity or someone's in real estate, their portfolio is going to look different. If they put 1,000 hours into studying Bitcoin, their portfolio is going to look different. But that's kind of my kind of base example that I give people to consider if they're just figuring out from scratch, roughly what is a good way to allocate money.
It's been so interesting to see how these assets perform, including Bitcoin when it emerged, but we've had this, it was decades-long secular bull market in bonds coinciding with the end of the debt cycle. And so let's zoom out a little bit and talk about that, because on a global level, what does that mean for the US and for the dollar as we see other countries look to de-dollarize and diversify their own treasury reserves? So what do you think about the future as we see a world that moves from unipolar to multipolar?
So this is a theme I've been writing about for a while, and then obviously the war accelerated it. But it's basically the shift towards a more multipolar world. And if anything, that's a shift towards a more natural world. kind of the anomaly is to have a country that's got, say, 4 or 5% of the world population, and their currency is used for 90% of currency trades. That's a situation that's actually really hard to maintain indefinitely. That's almost like it's based on the path dependence of how we got there. After World War II, the whole thing that followed, kind of being, you know, the last country standing, really, and the momentum that that's given us for a very long time. But I think even in a healthy environment, it's natural that as you get the rise of China and India, as you see kind of the normalization of GDP around the world relative to population, at least to a degree, and countries want it to be more sovereign. They don't want to have one country be able to shut off all their reserves or shut off their payment paths, especially now that there's technology. I mean, there's, you know, even CBDCs, as bad as they are, from a sovereign perspective, they're like, we can just go around SWIFT now. We can build our own payment channels. So instead of all payments just going through New York, they can build their own little payment channels back and forth. And I think that's the trend we're seeing, is going to be more reserve diversification and more payment diversification in kind of this intermediate term as this plays out. And then there's, you know, gold is a lot of central banks are buying gold because that's kind of the neutral ground. It's kind of this inherently scarce, inflation adjusting thing. And then you see smaller countries that are maybe able to take more aggressive decisions getting into Bitcoin. El Salvador is an example everyone knows. Probably a lot of people here saw the news about Bhutan. The Kingdom of Bhutan is mining Bitcoin. And it's not small. I mean, especially relative to their GDP, it's a pretty sizable, you know, they have some serious Bitcoin people there that must have done the work, because they have a pretty sizable mining interest relative to the size of their economy. And I think that countries that are able to either take the time or that are willing to make a bigger bet and willing to withstand volatility more, you can see Bitcoin as part of that solution as well, obviously.
Well, it sounds like the asset classes that make up this $900 trillion collective supply of money around the world, or debt rather, most of it's debt. It sounds like it's going to be changing, right? More of it's going to go into Bitcoin, and you can play with some of those tools on your portfolio, right? Can you speak to a little bit of how when Bitcoin kind of sucks out the monetary premium from these asset classes, like say real estate or bonds, what that could mean for not only your portfolio, but, you know, the price of Bitcoin in general and these other classes of assets?
Yeah, absolutely. So as I said, the first tool we built was a portfolio allocation tool, and the criticism I got a lot about that, which is also, I think it's a problem, is that it's all backward looking. So we all look at past data, we all look at what happened in the past, and that doesn't tell exactly what's happening in the future. So one of the things that we built also is what we call the Schrodinger model. So very quickly, what the Schrodinger model is a way to look at Bitcoin and the probability that it would capture the monetary premium in different asset classes. So real estate, for example, we know that real estate has a massive monetary premium, right? I don't know if it's 20%, I don't know if it's 50%, I don't know if it's 70%.
But it's hundreds of trillions.
Exactly, it's hundreds. So the world real estate market is estimated to be, depending how you look, anywhere between, excuse me, 300 and 500 trillion. So it's a massive market, right? I would guess that half of that is monetary premiums. People buying second house, investors buying house, you know, just to flip and all of that, right? I think the US is a great example of that. You know, that more than half of the houses are not owner occupied, right? So that means that there is a huge monetary premium in that. Why are people doing that? Well, we all know why. Because you have to put your money somewhere. There's excess liquidity. If you had money in your account that was good money, you wouldn't really need to do that. So money seeks alternatives as a long-term way to hedge against inflation, depreciation, and all of that, right? And real estate has been, in the long term, you know, the first asset that comes to mind. I'll say, you know, in emerging markets countries, you go through, you know, Peru, Ecuador, talk to people there, what they think about doing, you know, when they have savings is buying homes and, you know, buying different homes, because it's a way for them to diversify and to keep their assets safe in the long term, right? Let's imagine a scenario where Bitcoin captures some of that monetary premium, because it should, right? It's an asset that I don't know if it's going to capture 10% of that premium, it's going to capture 50%, but I think it's going to capture, and I think actually that's happening already, right? I can tell you, I had real estate as investment, I sold everything, and you know, I don't need to say where that went, right? So it went to a better asset, you know, it's something that I don't need to pay maintenance fee, taxes, you know, worry about legislation that it's changing, all of that. So what you can do on the same website that I mentioned, Nakamoto Portfolio, you can actually, don't take what I'm saying for granted, go there, and we have the different asset classes. So we have real estate, gold, silver, equities, bonds, all of them there. And it's a very simple model. This is pure simple mathematics where you multiply the asset class total market cap by the percentage that you think is the monetary premium of that asset class, by a probability that it's going to capture that asset class. And then you say as an input, say, okay, I think this is going to happen in 1 year, 5 years, 10 years, 15 years. And then it's just bringing to present value what that would be. And it would actually show you a chart of, okay, given this is what you believe, this is where Bitcoin price should be right now if it effectively captures that monetary premium. Now, another funny thing on conversations I'm having with some investors is I actually flip the conversation. I go to them and say, okay, so I understand you don't think Bitcoin is going to work out, right? But are you 100% sure that that's going to happen? And then they'll say, no, I think it's just a high probability. Okay, so what's the probability? And I go, I don't know, I think 80% chance that it's going to go to 0. Okay, so there's maybe 20% that you think it's going to work out. And if it works out, right, how much do you think it captures of the real estate market, for example? And I'm always shocked at the percentages that they will tell me. They're always much more bullish than the ones I have in mind. They say, no, I think it's going to capture 15% of that market. And then I plug the numbers in and say, okay, so if you think that Bitcoin should be worth today $150,000 today, if what you're saying is true, right? And that just gets their mind completely blown.
All right, I want to hear from both of you. Lump sum or dollar cost average?
I guess I'll go first. So my approach is one of those things is the difference between what the math shows and actual behavioral, how people behave in the real world. And so any structurally rising asset, whether it's the NASDAQ, S&P 500, or Bitcoin over a long enough period of time, usually if you run the numbers and say which better, lump sum or DCA, the answer will be lump sum because you got in earlier in an asset that is structurally rising. But that assumes a randomly assigned lump sum. And of course, what we see in practice is that lump sums are more likely to happen near the tops of bull markets, and they're less likely to happen in the depths of bear markets. So in practice, when you actually look at data of some of these companies, you tend to find that people who dollar cost average outperform people who do lump sum. Now, of course, if someone's a contrarian investor, if they are looking at some of the, Bitcoin obviously is hard to value in any sort of like multi-month basis, but if you're looking at it compared to say a 4-year moving average or compared to the average on-chain cost basis, kind of things like that, if there's multiple things saying it's in a value zone, lump summing I think makes more sense. Whereas when you have multiple metrics saying it's quite overbought, it's way above its moving averages, it's way above the on-chain cost basis, people talking about like Dogecoin on SNL, like when that kind of thing starts happening, that's when maybe you start looking at the dollar cost averaging. So a strategy that I've been kind of recommending is dollar cost average, and then if you ever find that it's in a particularly attractive, kind of out of favor value zone, add more maybe. But I tend to focus on that behavioral element more than just what the math says.
I should have bought more at 16. Hafa, what does the tool say about lump sum versus dollar cost average?
Yeah, I think as Lynn said, just first a definition, right? So when we're thinking about lump sum versus dollar cost average, what I'm thinking about is, let's say you have today $1,000 in your account, and at that point you have the decision to make. Am I going to deploy the $1,000 today? Or am I going to buy, maybe $100 for the next 10 days? It's very different than what we see with a lot of our clients, which are receiving, let's say, a paycheck every 2 weeks, and then they're deploying capital to Bitcoin. That, for me, is just a series of lump sums that they're doing, right? The capital becomes available, and then they deploy the capital. As Lynn was saying, we ran the numbers, Bitcoiners run the numbers, so we ran the numbers, and if you look in the past, lump sum beats dollar cost average. There's no question about that, right? But the psychological part is really, really important. And a couple of numbers. If you actually look, somebody bought at the all-time high, and they bought every single day since the all-time high until now, they are actually making money. They're making more than 5% now, while Bitcoin is down 50%, right? A little bit more than 50% since the all-time high. So that just shows that, in bear markets, it makes a lot of sense. For the last year, if you kept buying Bitcoin, every day for the last 12 months, you're actually making, I think something like 15, 16% in this whole year. So in bear markets, it makes a lot of sense. The question is, okay, so after I said, I'm going to do this in bear markets, I'm going to do DCA, and then in bull markets, I'm just going to do lump sum. You never know, when it's a bear market until after the fact. So the best thing to do is to size it appropriately. It goes back to our original conversation. Just think about the number that you know that you can hold in the long term, and if it drops 50, 60, 70, 80% in your face, you're not going to freak out and sell out of it. You're actually going to have more capital to deploy at that time, right? So sizing it appropriately is the most important thing.
That's how you know you're a true Bitcoiner, because when the bear market hits and the price drops, you're actually excited. You can buy more at a lower cost. So, okay, we have only a couple minutes left, but I really did want to ask you both about AI, because I know Rafa has a really interesting story. AI has been helping him with the Nakamoto portfolio, but in general, that idea that Jeff Booth has written about, technology is deflationary, but our system needs constant debt and inflation. So, talk to me about what you think AI will do, and will that help Bitcoin?
I'll tell a story, which is what you mentioned. So the Nakamoto portfolio, I'm not a coder. I know how to code, but I'm not a really good coder. My background is, again, in the financial markets. So a few months ago, when I decided to write this down, I was just starting to use ChatGPT. So what I did is, the first thing, I actually have this saved. I'm going to put this on Twitter at some point. I wrote it down, I said, I want to write a website that it's like this, that has this look and feel. How do I do that? I have some back-end code that I already wrote that does the calculations. Give me the front-end code. And it spit something out to me that was like 80% there. In the past, if I wanted to do something like this, I would have to hire a web designer, a front-end designer, hours and hours of me conveying the message to them of what I wanted them to get done, them coming back, with a draft and coming back. This was all done in a few weeks. So I don't think there's a better example to show how deflationary AI can really be in the short term.
Yeah, and I love your take, Lynn, and you'll be our closing statement as well.
Sure. I think this actually brings up the quote from Michael Saylor that inflation's a vector. And so if you look at inflation from, say, over the past 100 years, it's not evenly distributed. Some things that are truly scarce, like waterfront property, gold, things like that, have had the highest, generally, rate of inflation of their price. Then you look at things that are semi-scarce, like they're energy intensive, things like, oil or beef. Right, if you look at things like that, that's also generally risen above the official CPI rate. Not in a smooth line, but generally the long term is that these semi-scarce things, medical services, for all that kind of stuff is still going up at a pretty high rate. And then the actual CPI is kind of dragged down because you have certain things that are very low inflation or outright deflation that we've gotten very good at making more of, like electronics, software, plastic toys, textiles. You've had these kind of very deflationary categories, and so the average might look like, say, 3%, but it's varied between, like waterfront property might be on average like 7%, and, like electronics are like literally deflation. And I think AI further adds to that, which is that it makes certain services very deflationary. The cost of building a dynamic website, for example, let alone a million other applications, becomes way more accessible, way cheaper. But energy-intensive things or scarce things are not necessarily affected by that unless we have certain decision points, like if AI gives us material science breakthroughs and changes our energy situation, then maybe that makes everything deflationary. But unless you have certain kind of Boolean outcomes like that, I think the trajectory is scarce things probably quite inflationary, especially because of all the debt in the system, all the monetization that they probably still have to do over the next, say, 20 years as we go through this demographics bulge. But I do think this is a new deflationary, or at least an accelerated deflationary component that's going to make certain categories offsetting some of those inflationary categories.
Scarce good, easy to produce, bad. I'm so grateful that I get a chance to talk to two such smart people. Thank you so much. I could talk to you for an hour, but we're out of time. I'm so sorry. Please give a round of applause to Lynn Alden and Rafa Zagori. Thank you, guys.
Thank you, guys. This is a phenomenal panel. You guys did an amazing job. If anybody wants to learn more, this has been hosted by Swan Private. We do these events all the time.